morning, depending where you are. Thank you for joining us for today's training on mortgage insurance fundamentals for loan officers. Um, Very important topic here. Many people don't understand how important mortgage insurance is to providing liquidity to the residential mortgage market. Everybody takes it for granted that borrowers can routinely buy with 3%, 5%, 3.5% down payments, but that would not be possible if exist. Now, in this training here, we're not going to be covering FHA mortgage. We're going to be covering PMI, private mortgage insurance, for conventional loans. So let's get right into it here. So, what exactly is private mortgage insurance? Private mortgage insurance is a financial guarantee that reduces loss to the lender or investor in the event borrowers do not repay their mortgage. Mortgage insurance is required at LTVs above 80%. So 80.01% or above LTV, you need mortgage insurance. Now, like I was already mentioning, the benefits is of MI is it allows high LTV loans, right? It's not a guarantee, right? The loans go up to 80% unless there's additional guarantees, and in this case, mortgage insurance. Um, so another benefit to MI is the ability to cancel when no longer required, right? As compared to mortgage insurance on an FHA loan, PMI, you can cancel it, which we'll get into in a bit. PMI also gives increased buying power for the buyers because, like I mentioned, how else are those buyers going to buy a home if they don't have the 20% down? The only way that they can do it is because of mortgage insurance, the extra security and assurances that mortgage insurance offers um, to the deal because it reduces the lender's exposure to losses. So, for example, when you're getting your quotes, right, you may see that for a 97% LTV quote, it's going to state you need 35% uh, mortgage insurance coverage, right, for 35% of the loss. Um, 95%, you'll see that it says 30%. And at 90% LTV, for example, you'll see that it says 25% coverage. So that's how the amount of the MI would be lower according to the loan amount. But please also note that mortgage insurance, or should I say private mortgage insurance, is loan to value as well as credit score based. You already saw that the lower the LTV, the percentage of coverage has to go down. The lower the credit score, the higher the amount. I mean, I've had scenarios where with a 640 or 650 credit score on an agency loan, borrowers paying $500-600 a month of MI. That would definitely be a scenario where you would be looking at an FHA loan, since the mortgage insurance on the FHA loan is based on the loan amount times the factor, right? 0.55% divided by 12, as opposed to mortgage insurance, which is based on a factor, but it's also that factor is going to be based on the credit score of the borrower, as well as the LTV. Now, different ways to order mortgage insurance. I guess this is more of a procedural item for the loan officers, but please be aware, in some cases, the investor underwriter orders the MI when they handle everything. And in other cases, the MLO has to order the MI individually from whatever MI carrier that you are choosing. Please note that when the loan is submitted to MI for review, it's like there's an MI underwriter. They're going to review the file just like the underwriter at the investor reviews the file, and they're going to underwrite it. And in some cases, we do have situations where the underwrite by the MI underwriter conflicts with the underwrite of the investor underwriter, like, which meaning they could have actually more conditions, give you additional conditions that you didn't expect, and now you got to go back and provide additional documentation. So please do note that MI does need to be approved, and there is an underwriting process, and they are going. Hold up, everybody. Let's get this going. All right. Thank you so much, folks. We had a little technical difficulty there, but we're back. Had a little loss of power here. So hopefully didn't lose everybody. Let's go back into the presentation here a minute. All right. Okay. So we were going over mortgage insurance, and we were going over basically the benefits of mortgage insurance. So we already went over the benefits, reduces lenders' exposure, and then we were talking about how you order mortgage insurance. Actually, that's where we were at when I was cut off with my power surge here. So you're either going to order the mortgage insurance directly from the mortgage insurance company, or the underwriter will order it for you. So you really have to make that determination on where you're submitting the loan, and make sure who's responsible for the mortgage insurance. Now, let's get into the types of mortgage insurance. And again, we're talking about private mortgage insurance here. Um, the most common option of mortgage insurance is borrower paid mortgage insurance, where there is a monthly premium, right? It's paid monthly. It's set on a factor, annual amount divided by 12. Uh, Now, the benefit of having the monthly premium is that it may be canceled in its entirety when it's not needed. You won't be, billed. You won't have to make the payment anymore, and there is no upfront premium, right? It's basically monthly payment, right? The second option is the single premium mortgage insurance. It's a lump sum payment paid one time. Now, that can either be paid by the buyer, the borrower, by the seller, by the builder. Um, Now, the benefit of the single premium is that there is not a monthly payment. So there's a one time cost, which is the expense. Now, again, it can be paid as a closing cost, or it can be financed into the loan amount. Um, so, and again, it may be a portion of it may be canceled. But the big benefit of the single premium is that there is not a monthly payment charged to the bar. So it doesn't appear. It's not part of the PITI, right? So it doesn't appear in the DTI. So if, for example, you do have that $12,000 or $13,000 annual premium, or whatever it could be, $600 or $700 a month, right? But maybe if they get it as a single premium policy, okay, it's going to be a little bit higher amount. Could be 12, 13, 14, $15,000, but it's a one-time fee, right? So that four, five, or $600 a month that is going against the borrower's income will no longer be there, so it will not affect the DTI. So if, for example, that four, five, $600 a month in mortgage insurance was taking you over the top as to as to the maximum allowable DTI, now, if they can come up with the money, then they wouldn't have that problem. And there's many ways to get creative there. If you have a seller contribution to the closing, or the borrower simply has the money because the $10,000 or $12,000 in additional down payment, for example, to try to bring down the payment, isn't going to affect the payment as much, because that could be $5, $6, $7 a month per thousand, isn't going to affect the payment as much as if you pay that mortgage insurance up front, one time payment, and then you eliminate that high mortgage insurance payment. And again, specifically, we're talking about here for scenarios of borrowers that have lower credit scores, where the mortgage insurance is really high. We're not really talking about an MI payment of $40, $50 a month, right? So that's this, but this is a solution, and it has worked out in many loans where the single premium has been paid. And by the way, good news is we even have a lender paid MI single premium, right? Where the premium is paid by the lender or a third party. However, the cost for the lender paid MI is not free. That cost is going to be paid for by higher interest rate, and it could be some additional fees that they add, but definitely you're going to have a higher interest rate when you have lender paid MI. Now, the last topic that I wanted to cover here was MI cancellation, right? Cancellation of PMI, because there seems to be a lot of mystery in the market as to how you can cancel the MI. This is a very important takeaway from this training. The first method for MI cancellation is automatic termination of the MI at 78% of the original value of the home. Not the current value from an appraisal, but 78% of the original value. We have automatic termination. The second way it can be canceled is that the borrower requested it at 80% of the original value. Right? Notice we're talking about original value. So whenever we're talking about original value, there's less restrictions, right? Because the original value when you bought it, and for you to get to 80%, you either paid down a lot on the loan, right, up front, or a lot of time has passed, and now you're at 80% LTV based on the original value. However, many people don't want to wait till they get to 78% for an automatic termination or 80% of the original value. They want to try to cancel that MI as soon as possible. So, in order to use the current value, right, you are allowed to request cancellation of PMI using the current value, but a couple conditions. The loan has to be seasoned for at least 2 years, and the borrowers have to have an acceptable payment history. But a couple additional restrictions here. If less than 5 years have elapsed since the origination of the loan, then you have to be at 75% LTV or lower. If more than 5 years have elapsed since the origination of the loan, then you only have to be at 80% or lower. But keep in mind, this is using a current appraised value and not the original value. So let me recap the key takeaways from this training before we end the session today. Remember that PMI allows borrowers to finance at higher than 80% loan to value, which gives greater liquidity to the market. Uh, we do have single premium policies, which can be paid in a lump sum so that you eliminate the monthly mortgage insurance expense. So that if your borrower didn't qualify because of that extra 100 or 200 or 300 or 400, whatever is the MI, paying it as a lump sum, you can get rid of the MI. We also have lender paid single premium MI as another option. And then remember, on the cancellations, we have automatic termination at 78, borrower requested at 80%, both of the original value. And if you want to use the current value, then less than 5 years, 75% LTV, more than 5 years, 80% LTV. So, are there any questions regarding mortgage insurance? Oh, I do not see any questions here. I'll give it a minute. So, we are good to go, and I will see you for tomorrow's training. Thank you, and have a great day.